Hello guys, welcome back to this YouTube channel. It's really been an interesting journey with you guys, going over these concepts that seem to be very complex, but we found ways to try to break them down. I appreciate the questions that have been coming in. I appreciate the feedback, commendations, and everything that I'm getting from you guys, and it's just been really phenomenal. Always remember to subscribe to the channel. It helps me know that you like what I'm doing. Like the videos, share them with your friends, so that I am at least a little bit more motivated to continue to do this. So thank you for all that you guys have done so far. I really, really appreciate this. You make me feel like I'm not alone doing this. That said, we are going to be discussing the topic withholding tax today. Yes, withholding tax. I know you people have really wanted me to talk about this topic, but now is the time. We've spoken about VAT in the past, I believe, and this time around we will just try to demystify what withholding tax is. But I will start with a shocker. Withholding tax is not a type of tax. Is that surprising? Oh, but we pay the tax. Government will come and tell us to pay withholding tax, this one, that one. I am telling you for free. Withholding tax is not a tax in itself. It's just a way by which government collects another type of tax. You're wondering, what is he saying? What does he even mean by that? So you remember we mentioned in one of the previous videos, we'll probably link it to this one, where I spoke about income tax. That is, as an individual, you pay personal income tax. And as a company, you pay corporate income tax. Now, at the end of the year is when these taxes are due. So for example, if your business year ends in December 2023, you have from January till June 2024 to pay that tax. Now imagine if the government has to wait for the whole 6 months before they get that money from you, which means that they will wait for the whole of 2023 and then wait till maybe June or maybe May, whenever you decide to pay, to collect the tax. How would they run? How would they survive? So they devised a way that they can be collecting taxes in advance so that they would have something to run. And that thing is what is called withholding tax. As the name implies, withhold is to take something back, like you owed something back before a particular payment is made. To sort of explain it a little bit more, withholding tax is an advance payment of income tax, which means that if you are liable to pay income tax, you are liable to pay withholding tax. So the government is saying, yes, at the end of the year, you are supposed to pay me 100K in taxes, but I will not wait for you to give me that 100K at the end of the year. I will take any sale that's, any transaction that happens within the year, I'll be taking money from you every month. So that when you are supposed to pay your tax 100K at the end of the year, the total tax that I've taken in form of withholding tax, I would deduct it from your total tax and then you would pay the balance. That is exactly what withholding tax is. So in summary, withholding tax is an advance payment of income tax. And it is only people that are supposed to pay income tax that should be paying withholding tax. I hope you understand. So now that we know that withholding tax is not a tax, it's not a form of tax in itself, it is an advance payment of tax. Why did the government introduce it? Of course, we have mentioned that the first reason is so that they have money to be able to run the government. Another thing is to curb tax evasion, right? So if I am obliged to take off money in form of taxes before paying you, so if I'm supposed to pay you for something that you did for me, and government places a responsibility on me to pay them from that money before paying you, it means that it becomes more difficult for you to run away from tax. which means that the government can gather more people into the tax net. That's another reason why the government does withholding tax. And because it is a tax on only income, you cannot use it to offset any other kind of tax. So let's say you owe VAT, or there's a penalty or interest that the government is charging you. You cannot use withholding tax to reduce that one. But you can use withholding tax to reduce income tax. Now, who can deduct withholding tax from you? Who is allowed to deduct withholding tax from you? The answer is very simple. Anybody, institution, organization that is permitted by law to run the payee system. Payee is, paying tax on behalf of employees. If the person can pay tax on behalf of employees, the person can deduct withholding tax. So what does this mean? It means that an individual that is a person, a human being, cannot deduct withholding tax from you because they are not authorized to run the payee system, right? Even though a person can employ people by himself, so I can employ maybe a housekeeper for myself. I am not authorized as an individual to remove tax from my staff and pay to the government because I am not a business. I'm not recognized as a business. I'm not a government agency. I am not a ministry. I'm not a department. I'm not an NGO, right? I'm not any of these things. So I cannot take out withholding tax from you. So individuals typically cannot deduct withholding tax. However, any other person, any other organization that is, allowed to run the payee system can take withholding tax from you. You will ask me, NGOs, do they need to take out withholding tax? Yes. Even though they themselves may not be paying tax, they make payments to people that are supposed to be paying income tax, so they should be deducting. And this is like a typical thing, question we find a lot of NGOs asking. Am I supposed to be deducting withholding tax? Yes, you are. If you run a non-governmental agency and you are paying for a technical service, for example, or a professional service, for example, you're paying your auditors, you should take out withholding tax, right? The ministries, government ministries, departments, agencies, those ones too, even though they themselves do not pay withholding, they don't pay tax, they are allowed to deduct withholding tax. However, I've seen situations where somebody asks me, must I deduct withholding tax? Yes. In most cases, if the transaction that you're dealing with has to do with withholding tax, you should deduct withholding tax. And we'll get into details of that a little bit later, right? There is, I think there is a law that says that if a ministry does not deduct withholding tax, the Accountant General of the Federation, the Accountant General can actually calculate the withholding tax and remove it from the budget of that ministry at the end of the year. Right? That's to tell you how serious withholding tax is. Even if a ministry does not pay, they will take it out of their budget. That's what the law provides. So, withholding tax is that administration process that allows the government to collect income tax in advance. And who are those people that are allowed to deduct withholding tax from you? They are anybody, any organization, any institution that can run the payee system. That is, they're legally allowed to employ staff and take tax from that staff and pay to the government. So, we've spoken about what withholding tax is and who exactly should be deducting withholding tax. Now, how exactly does it work? It's very simple. When I purchase something from you, for example, you're supposed to pay me, right? Yes. So the government is saying, don't pay to me in full. Hold on. Pay a portion of the money to me and give to me the rest. It's that simple. They ask that you pay them some portion of that money in form of tax, and then give me the rest. They're just trying to collect their tax in advance. That's all it is. Now, in return, what do I get to show that you have actually paid the tax on my behalf? Because if you pay me part of my money, I will have received that one in my account, right? How do I then know that the other part that you are supposed to pay, you have paid it? And that too is simple. The government introduced something called withholding tax credit notes. It is more like a letter that you will give to me in addition to the payment. So you will give me the payments. Let's say the total money you are supposed to pay me is 100K. You will pay me 95K and pay 5K to the government. Then you will now send the 95,000 to me and send me receipts of 5,000. That 5,000, you would have paid it to the government. Then the government will now give you something called the withholding tax credit note. It's like a receipt of 5,000. So what you will be giving to me is 95,000 plus that receipt. That receipt is called withholding tax credit note. Now, in the past, it used to be difficult because you as the seller would take you as the buyer would take a whole month before you eventually pay the government, before the government does their reconciliation and give you the documents back. So it takes a lot of time. But the recent introduction of the Tax Pro Max, made it a lot easier. I have a tax identification number, and you too, you have a tax identification number. So you will pay the government, and then you will put my tax identification number there. Once you put it there, it will automatically reflect on my own system. That's just what it is. So, that process, that document that I get, showing that you have paid the tax on my behalf and you have fully paid up that money, is called a withholding tax credit note. I hope that's clear. Now, who collects withholding tax? In one of my videos, I had mentioned that you register with the states. Sometimes you register with the federal government. And ideally, every business should have registrations with both. In the future, we're looking at a situation where the government harmonizes it all. But for now, you have to register separately. But who then takes withholding tax money? Is it the federal government or is it the state government? And if you've been following, this channel judiciously, by now you should already know the answer. Because you pay tax to the federal government as a limited liability company, you pay income tax to the federal government, right? Your withholding tax would go to the federal government. It's that simple. Remember, withholding tax is like an advance payment of your income tax. So if you are paying your income tax to the federal government, your withholding tax should also go to where? The federal government. If you are paying to an individual a business name, for example, remember we mentioned that a business name is like an individual. You are the business is you. For those kind of people, they pay their income taxes to the state. So withholding tax related to those people should be paid to the state. That's it. It's not one size fits all. The person that you are transacting with that determines where you pay the withholding tax to. What is the withholding tax rate you should be paying or that should be deducted from your invoices? I've heard somebody ask me before, I want to collect 100K from this person. Should I add the VAT and also add the withholding tax? Typically, withholding tax, because it's not a tax, you should really not be doing that. It is, in the real sense of it, an advance payment of your income tax. So while it affects your cash flow, it doesn't exactly reduce the value that you are getting. That's one thing I want to first lay out. And what is the rate? It's 5%, it's 10%, it should be 5%, it should not be 10%. See, the law is clear on what withholding tax rate should be. Depending on the category of service or products that you are buying, the rates are there. And to the person you're selling to. So there are two things you must consider when you want to think about withholding tax rates. First, who am I selling to? Are you selling to a corporate individual that is a limited liability company? Or are you selling to a partnership or a business name? If you're selling to a limited liability company, you will be charging them, most likely than not, 10%. So the government has this list, dividend interest and rates, hiring of equipment, technical, professional, and management services. So many. The list on the law is everything that you're paying to a government or a company, a limited liability company, or a public limited liability company, a PLC or an LTD. It should be 10%. For those of you that may not know what I mean by public limited liability company, private limited liability company, you may need to go and check out the video that talks about business registration demystified, right? When you check that one, it explains what each of these things mean. So for companies, the withholding tax that needs to be deducted is 10%, most likely than not, except for construction. So when you are constructing roads, you are constructing a building, you are constructing bridges, the rate is different. It is 2.5%, right? So for construction, if you are relating to a company, it is 2.5%. For an individual, and when I mean an individual, I'm talking about, a business name and partnerships, basically. The rate is 10% for hiring of equipment, 10% for dividends, interest, and royalties. All others, 5%. Remember, dividend, interest, royalties, 10%. Hiring of equipment, 10% for an individual. Everything else, 5%. So construction for a company is 2.5%. Construction for an individual is 5%. Just to reiterate, what does this mean? It means that if my company has a contract with your company, so let's say I'm supposed to render accounting solutions to you, you are supposed to deduct 5% from the payment you're supposed to make to me if I am operating as a business name. But if I'm operating as a limited liability company, you should take 10% from me. I hope that's clear. So that's how we administer withholding tax, and that's the rate. Now, because of everything that I do, I'm dealing with different kinds of people in 1 month. The government says that for all the withholding tax that I have collected in a particular month, I should pay it on the 21st of the next month. Right now, on the 21st of January, every company is expected to pay withholding taxes that they have collected in December. So all the withholding taxes that I deducted from, my suppliers' bills in December, I should pay before January 21st. I should file and pay. In case you are wondering what's the difference between filing and remittance, also, I think we did a video that talks about tax filings and tax remittances and the differences as well. So you can refer to that video. A lot of the terms that you see me talking about now, we've actually made them extremely easy to understand in a previous video. That said, what are the exemptions from withholding tax? The clear one is this: if you are not supposed to be paying income tax, you should not be paying withholding tax. That's number one. And this is not one size fits all. I try to, because for example, an NGO in itself is not supposed to be paying income tax. However, when they go into business, let's say they now have a hall for rental, or they have a bar that they're using that's business, right? That's not part of their NGO objects per se. That bar becomes a business that is supposed to be paying tax on its own. So withholding tax is due. So any income that is not due to income tax should not attract withholding tax. That's the first thing you should know. What other things are exempted from withholding tax? Interest on bonds. I know that may sound a little cumbersome, but if you buy treasury bills, treasury bills is like all these things that the federal government is like. When the government wants to borrow money from us, they will now say, come and buy treasury bills, then they give you one paper. Interest on treasury bills does not attract withholding tax. Claims on insurance, right? Let's say your car damaged and then you got an insurance claim. No withholding tax. Transfer between banks, right? No withholding tax. There is also a very interesting one. Over-the-counter transactions do not attract withholding tax. And that's a little bit tricky. What do I mean by over-the-counter transactions? Now, if you buy things, let's say you go to a malam shop and then you decided to buy bread from the malam, no withholding tax. That one is for two reasons. Because first of all, the malam is an individual, right? You cannot deduct withholding tax normally. But even if he is not, because most of these transactions are over the counter, you just go to a shop or an organization to buy, no withholding tax is attracted. Now, this brings a very interesting nuance. So if you buy raw materials, for example, and you have a contract of supply with the person that is selling it to you, withholding tax may apply, right? But if the same kind of thing, but you actually, go and transact and purchase the raw materials with the person from the person, maybe in their shop or whatever, no withholding tax, right? So, you need to be aware of these things. I think there are a little more. For example, if you have an holding company, I think the video about business registrations, I talked about holding companies. Holding company is like a group where you have more than 3 companies already. Then you now register one company that owns all the 3 companies together, right? You probably have heard of ES Holdings, all these holdings, First Bank Holdings. If you have an holding company and you generate dividends, then that dividends, you redistribute it. That also does not attract withholding tax. Then there are some special considerations that you need to be aware of, and I'll just try and run through them quickly. First is rent. Commercial rent attracts withholding tax. So if a company is renting a property for commercial use, they pay withholding. They should be, deducting withholding tax from the landlord's money. So what we would typically, and if you don't deduct it, you will self-charge yourself. So if you are renting a house for commercial use, you should attract withholding tax. If you are renting for residential purposes, no withholding tax. So that's a special consideration that you need to be aware of in terms of withholding tax. Another special consideration is there are certain payments that the withholding tax is the final tax. Once you pay the withholding tax, you are not supposed to pay any tax on that money again. For example, you have a contract of sales or a contract of supply with a company that is not in Nigeria. Because the company is not in Nigeria, the withholding tax that you deduct from that payment you are giving to that company is the final tax on that money. Then dividends, the withholding tax is the final tax on that money. Royalties, the withholding tax is the final tax on that money. So this, categories is what in accounting terms people would call franked investment income. But forget about that jargon. It's just simply saying that any income that falls into this category, dividend, interest, royalties, or payments that you are making to outside parties, people that are not in the country, non-resident Nigerians, that's withholding tax you have paid, is the final tax you are supposed to pay on that money, and you should not pay anything extra. I know this may have been a little bit too much, in terms of like the technicalities of it. Feel free to send in your questions, comments on this video, so that we can respond to all these questions that you have. That said, we've come to the end of this episode. Thank you for watching. Remember to subscribe to the channel so that you can get more videos like this. Turn on the notification bell so you are aware when new videos pop up. And of course, share with your friends, share with other business people around you. And see you in the next episode. Thank you.